Hello everyone, Vince here from Unifirst Financial. I want to address a problem that many young people have today, managing money and debt, as well as saving and developing a retirement plan. But before I do so, I want you guys to hit the subscribe button so that you can stay up to date on current strategies that will help improve your approach to personal finance. Okay, with that said, let me get right into it. Young adults today are facing many hardships that other generations did not. Because the cost of living and education is so much higher than before, many hard-working families are having a hard time managing their money and debt, let alone saving. Now, I'm not talking to those who are living extravagantly or living outside of their means. I don't mean to be harsh, but those people have a much bigger problem. I'm speaking to those who are vigilantly trying to save, affluent young men and women, as well as their families. With the cards stacked against us, is there a way to get ahead? So let's think about that for a second. Do savings accounts or CDs provide you with the best opportunity to save? What type of earned interests are you getting on yours? What about placing your money in the stock market or other vehicles that have associated risks based on market fluctuations? What's your risk tolerance? What savings vehicle would you use to help manage your finances and plan for the future? Now, many companies today rarely offer pension plans. This was a clever financial tool that helped the generations before us save money. Yes, there are some organizations that offer their employees a defined contribution plan or a 401k, but is this the best route for everyone? So, how would you address this problem? There are many that feel they are losing an uphill battle. What financial instrument would you use? Well, that's why I'm here today. I will provide you with information that you can utilize to enhance your approach to personal finance. I will present how this financial instrument is one of the best financial tools for young adults and affluent families. I will take you through a hypothetical scenario that illustrates how a whole life policy that is designed appropriately can provide you and your family the protection they need and an asset that you can use for your current necessities while developing a retirement plan for the future. Let me introduce you to my friend Hugh Dewitt and his family. Just like you, my friends are hardworking parents with many concerns. As you can imagine, they too have issues that are always on their mind. They worry about their mortgage, their car loans and insurance payments, medical bills, etc. They also barely have enough to save for their retirement and worry about how they will pay for their children's college education. Because of this, they both know that they need a smarter way of managing their money while providing their family the protection they all need. So, what's the first thing they should do? Well, they should get protection for the people who matter most. I know some of you question that thought. Some of you may think that life insurance is just another bill or it's too expensive. Let me reassure you, when designed properly, you can use it for your current financial needs, as well as a deferred asset that will provide for your requirements later in life, as well as a tool used for your legacy planning, enabling you to leave your children an inheritance. I want you to remember these words spoken by Abraham Lincoln. The best way to predict the future is to create it. Does that make sense? Well, let me show you why and how. I mean, literally show you using actual illustrations. So, are you ready? Remember, I set a plan that helps you with your current needs and a better money management system. A whole life policy can provide a financing solution for your cost of living, major expenses, and even manage your debt. Again, I also set a deferred asset, a savings vehicle that provides guaranteed cash accumulation better than traditional savings and CDs offered by banks. Lastly, I also mentioned that it's a plan for your future. A whole life policy can help you develop a tax-advantaged retirement plan that will provide you with the ability to leave an inheritance for your future generations. Okay, so let me show you how. Let's look at Hugh's plan. Hugh acquires a life policy that provides for his family in case he dies. Hugh, at the age of 25, can secure a policy worth more than $1 million for as little as $63 a month. With the help of EMA, they also put away approximately $950 per month in their savings portion of their life policy. Now, after saving for 10 years, their policy has a cash value that's almost $140K. That's not bad, right? That's the power of compounding interest and guaranteed cash value. That's definitely better than using a savings account or a CD. In addition, this money has zero market risk and is protected from creditors. Are you starting to see what I'm talking about now? Well, we're not done. Let's fast forward 45 years later at their estimated retirement age. The cash value of this account is close to 1.8 million in the best case scenario, and in the worst case scenario, 1.2 million. I did mention guaranteed cash value, correct? Well, for now, let's focus on the non-guaranteed values. Just because in reality, this is the current rate that the insurance company values your money today. The guaranteed values, to simply put it, as I mentioned, is the worst case scenario. So for 45 years, Hugh and Ema contributed about $540,000. The equivalent in their later years is 3 times that amount. Wow, that's great. Well, I know some of you will say you can project similar numbers, if not better, using a 401k. Well, let me counter that argument real quick. With traditional banking methods, if you save that amount, you will have to pay taxes on it since you've deferred them all these years, correct? From 25 to 70, what happened to your tax bracket? It's gone up, correct? So how much are you taxed again on ordinary income? If you were at 28% tax bracket before, and now you're at 35% tax bracket, how much more would you be paying? Not to mention, what about your management fees? Okay, well, with that said, I want to point out that in this scenario, Hugh and Ema never really increased their systematic savings, did they? They've been contributing the same amount since they were 25. Anyway, let me continue. So how can you use this for your current needs? Let's go back and take a closer look, shall we? Let's say Hugh takes out $25,000 every 5 years for the next 40 years, for whatever reason. In year 6 of the policy, at the age of 30, Hugh borrows money to buy a car. In year 11, he pays for Alana's Sweet 16. 5 years later after that, he pays for her school loans. 5 years later again, he buys another car. Can you see how it's illustrated here? Try to keep up. There's an annual loan every 5 years once the account was capitalized, which is highlighted here in column 4. Do you see Hugh taking out $25K 4 times every 5 years? Okay, let's continue. So in year 26, 31, 36, and 41, Hugh continues to take out money to pay for Michael's school loans, take an extravagant family vacation, to fix the house, or maybe take that Vegas trip with the boys. Whatever the case may be, Hugh continued to take out $25K every 5 years. Remember earlier when we summed up their total contributions without taking out any money? That came out to a total of $540. But this time, we calculated loans for $25K multiplied 8 times, which is $200K, which he used for his current needs. So how much did they actually pay into that account? Well, subtract $200K from their contributions of $540, which leaves them with $340,000. That's how much they put into their account. Does that make sense? Okay, great. I know by now you're looking at that column and asking, what are those numbers under that annual loan? Well, let me explain. You're not actually taking the money out of your account. Instead, you're leveraging your account and taking out policy loans. Before you get into it, there's good reason why I'm showing you in this manner. If you'll let me continue, I'll explain everything. So humor me. It's not like I mentioned that you had to pay them back or anything, did I? Actually, I meant to show you that. It's highlighted right there. So Hugh and Ema invested less than $540K and took out loans for $200K. Again, how much did they pay? Right. So let's look at what Hugh and Ema has after taking out $200,000 for their necessitated needs. Can you tell me what their cash value would be at their expected retirement age without any loan repayments? Is that almost 1.2 million? Isn't that great? A sizable cash value, no increase in insurance, no additional contributions to savings, a 0 loan repayment, and still that much? Well, Some of the better bankers here are saying, what about that loan? Well, here it is. It's common sense that if you take out a loan, you have to pay them back. If you borrowed money from the bank, you would pay it back, right? So you should do the same here. After all, this is your bank, your own money management system. That being said, I know some of you are saying, why take out a loan? Well, the truth of the matter is you don't have to. You can always do a partial or a full surrender. But again, there is good reason why I'm showing you this approach. Besides, I'm sure two people setting aside $115 a week can pay back their loans. Yes, $115 a week. That's $115 times two people times 52 weeks, which brings you to $12,000 a year, which is the same as their annual contribution. Anyway, like I've been saying, this family has been working hard and saving smart, which affords them to pay back this loan. And there are other reasons why I'm showing you in this manner. By paying back your loans, you can reap what you sow. Let me explain. I said you can reap what you sow. If you were to pay back the loan of $200K over the course of 40 years, you would end up paying approximately $225K with interest payments, which would allow you to get back $626,491 back in your pockets. You ask me how. Well, take that $626,491 and add it to that $1,191,467 from your cash value. What does that amount to? Correct. That's the $1.8 million, which was your original cash value before you took out those loans. Yes. So when you take out your policy loan, you collateralized your money, and as long as you pay it back, you'll get it all back. Now, if you die, before you can pay it back, your loan plus your interest will be subtracted from your death benefits, and the remainder will go to your beneficiaries. The key takeaway is, as long as your cash value is more than your loans plus interest, you're generally okay. But if it does exceed your cash value, then you do put your policy at risk. So the trade-off is make sure you plan, capitalize, and collateralize properly. So anyway, back to the scenario. What do you do with that 1.8 now that you're your retirement age? Well, as expected, you can continue to use that money to grow your wealth, since that money will still continually compound over the years. Yes, you can accumulate more. Then when you move on from this world, your family receives that death benefit. They settle your final expenses, your estate taxes, and I'm sure they'll have enough left over to continually grow their wealth and provide for their future. Do you remember that number? Was that at age 85, they can receive a death benefit of $4.9 million? Okay, well, enough of that. Let's get back to scenario. Hugh and Emma is 70. Now, they have repaid all their loans plus their interests, and they're still well and good. People today are living longer, and that's great. So, with all that money, how do you take a tax advantage retirement? Well, the same way you did before. You can see here, instead of taking out $25K every 5 years, you can take out $60K every year. Taking it as a policy loan, you'd have enough money until you're 95 years old. After that age, in this illustration, when you're continually taking out $60K year after year, your total loan value is almost equivalent to your policy's cash value. But if you don't take out $60K every year, then you'll be fine. Look, it's improbable that you'll take out all that cash, since creating this plan afforded you many other opportunities. May I remind you that this was approximately $230 per week. You never increased what you were putting in. We haven't calculated Social Security benefits or figured out ways to maximize that. I never even got into mentioning other strategies that can help enhance these outcomes. Again, if the unfortunate happens, even with the loans year after year, your family's benefits will equal the difference of the net death benefit and the total loan value, which is a sizable amount. Do you want me to illustrate this and how it would apply to you? We can plug in your specifics. But the only proper way I can illustrate this is if you give me a call. so we can discuss your specific plans, your goals, and your obligations. If you'd like to do so, follow the link in the top right-hand corner and reach out to us through any of these social media platforms. Alternatively, you can also give us a call or shoot me an email. Look, I hope you guys enjoyed this presentation and hopefully you've learned something from it. Please make sure you consult a licensed financial professional if you're considering implementing this strategy. If you haven't done so as of yet, don't forget to hit the subscribe button. Thank you for allowing me to share, and I hope to see you guys in the next post.